Feroze Azeez, Deputy CEO Anand Rathi Wealth, who joins us this morning. Good morning, Feroze. Take us through why are markets in panic mode after budget?
So Kartik, of course, after budget, it is not so much of the budget's impact, as you can know. Over the weekend, Trump has done a lot of topsy-turvy decisions and some counter tussles between two countries which are reasonably well ingrained in trade, like Canada and US. Canada threatens to say that we'll stop oil exports to US, where 50% of US imports of oil come from Canada. So this uncertainty, which is the global uncertainty, is why the markets are marginally softer.
Okay.
Now, one thing, Kartik, each of us have to take note that any kind of turmoil does not result over the last few years of a gap down. Right? Have you noticed, Kartik, we don't get a gap down of 2%, 3%, which used to happen if you have been, which you have been for the last a decade and more,
right,
on the markets. You would see that earlier, before COVID, you would see so many news which come overnight would result in a 2% gap down, 1.5% gap down, and then market goes wherever it goes.
Right.
After COVID, after 22nd March, it doesn't happen because the unsung hero of this lower volatility in Indian market
is the retail
the
investor?
net short circular. Nobody can wake up in the US or any country for that matter and short Nifty unlimited.
Right.
Most countries don't have a limit on short. India has a limit on short selling, which is the right thing to do for an investor. So that's why it doesn't perturb me. This is not so much of a budget impact. It's more of the geopolitical uncertainty which is emerging. But still our markets are reasonably resilient because shorting unlimited is not permitted. We are one of the few top 10 economies. One of the few, none of the other economies have any short selling limitations.
Right, absolutely. And I think the SEBI circular that you're talking about really came in at the right time and tamed the negative action that could impact Indian markets. So you're saying this is a Trump threat, a Trump tariff threat, which is spooking markets right now. But Feroze, honestly, haven't the markets factored that in already? So is it just the fact that that finally Trump is seeing through on his electoral promise of putting tariffs on nations which he feels are being unjust to trade with US? Did markets not factor that in? And is this just coming because he's gone ahead and slapped tariffs finally?
See, Kartik, if you look at today's opening, for example, of course it is factored in is why the markets are, as we speak, down 0.9% on Nifty. Okay, approximately. Okay, we'll give or take. Right? 0.9% as per 18 standard deviation in a year. If the market is supposed to be volatile, if the standard deviation is supposed to be 18, the average movement per day is 1.2%. Anything more than that is abnormal. As per the standard deviation which Nifty or S&P 500 throws up, 1.2% move per day average is what 18 standard deviation implies. And that's what is the safest capital market, one of the safest capital market in the world, which is S&P 500, is supposed to move 1.1% a year, a day. And that's what the standard deviation means. So 0.9 implies that it's already factored in is why it is 0.9. If it was not factored in and if the market opens 3% gap down, where it's supposed to be doing only 1.1 per day, then I would say, okay, markets were not expecting so much of a stifter tariff from Trump. So I'm not too perturbed because it's still well within the range of what is the permissible volatility of Nifty. Like you have for valuations, for return, we look at PE. For risk, any abnormal risk should throw up more volatility than anticipated. And
all right,
that's 1.1% per day.
Good to have some optimism this Monday morning, even as markets open in the red. Feroze, before we move on to maybe budget impact on specific sectors, I want to stay with what is happening globally for just a little bit longer. Now, you mentioned that that foreign investors can't short the Indian markets beyond a point. I understand that, I respect that, but does it mean that the onus of ensuring that we don't go into a bear run is now with the retail investors and DIIs who are also banking on retail investors? Because it seems that foreign investors are going to continue to sit on the fences until there is greater clarity on tariffs.
Completely agree, Kartik. We can't actually live without 20% of capital market ownership. $900 billion belongs to FIIs. It's not, you can't let them go and still survive with even DI money and retail money and maybe corporates and bank treasuries, which are the participants in the Indian capital markets, because FIIs have brought you so far, right? FIIs have had a very large role in playing a large role played in the Indian equity capital market. Indians have a large role to play in terms of funding fiscal deficit for government. So I respect them immensely, and we can't survive without them. That's my take. The good part of FIIs, Kartik, if you break it down, which I don't know why the industry or most participants of the capital markets don't break it down into two parts. One is FII, which are long only, FII, which are prop traders. FII, which are long only, are pension funds in the US, for example, or any index funds which follow FTSE or MSCI indices. They have not sold. You look at their ownerships, it has only gone up in the last calendar year. And if you look at those FIIs, which are prop traders, ARB guys, hedge fund guys, they have in January sold all their positions in small cap, if my guess is right. So FIIs exit cannot be considered as one lumpy chunk. FIIs have two very different behaviors. Prop traders have a very short-term mindset, and the other index fund FIIs have such a long-term mindset, which is beyond my lifetime. So we generally use this FII word interchangeably between these two non-homogeneous sets. And that's the relief which I had, that the long-only guys have stayed put. DIIs have bought, January, retail has bought about 7,500 crores. Retail numbers don't get published so quickly. 13,758 crores is what first 30 days of January have brought from retail. Others, which is another category where corporates, HUF and firms are categorized, they have sold 7,400. If I look at these two chunks together, there has been a 7,300 crore positive from the retail and the corporate side.
All right, Feroze. Okay, let's move on now to Budget 2025 and impact, not on the broader markets, but sector-specific impact. Now, this, of course, Feroze, I think you'll agree with me, has been a budget where the focus has been on the middle class, and the middle class to prop up the consumption downturn that we had begun to see. And that consumption being 60% of the GDP, hopefully adding to GDP growth. So I want to get your take first on FMCG stocks and the consumption sector stocks. How do you see them faring in the year ahead?
Kartik, if you remember in my last interview with you, I would have said the last interview. The last interview was just
last was on budget day.
Yes. Yeah. So a few interviews back, let me be a little more correct. I told that our focus has been, we believe that ABC, which is easy to remember, automobile, banking, and consumption are the sectors to be focused upon. So that's why we had abbreviated as ABC. That gets reinforced in this budget. Now, why banking? Banking is already at its trough valuation. Banking, once the interest rates come down on the lower end of the yield curve, their deposit growth will automatically get resolved, which people are not speaking about. If yields on the short end of the yield curve come down from a 6.5 on the repo side to, let's assume, hypothetically 5% in a year and a half, or 2 years, then what happens is a 5-year FD gives you 7%, a 1-year FD gives you maybe 6%, and a 3-month FD gives you 5%. If this is the kind of yield curve, automatically people will start choosing longer dated deposits. So deposit growth will become so much more simpler if the yield curve is not flat, which it is today. And that's the major problem why deposits are not growing. In spite of that, Kartik, banks keep cribbing that the money is going into equity. It's such a wrong narrative, because 43% of last year's household savings went into deposits. 43% of 34.58 lakh crores went into deposits. And 43% guy is saying, yeah, why is equity taking away 4.5%? It doesn't make any sense. 17% is going into insurance policies, and insurance policies are largely pushed by banks. You're okay to give away your CASA balance and your deposit balance to insurance companies. But when it goes into equity, because there's not too much commission to be made, banks are creating a narrative that equity is taking away assets. Last year's 6-7% total equity, including direct equity, is abysmal to a country's saving put into equity markets. So I don't think that DIIs will have any time a liquidity crunch.
Okay, let's talk about the banking sector a little more. There has obviously also been a credit enhancement for MSMEs. This means that maybe the banking sector should see more demand for loans coming their way. At the same time, all eyes also happen to be on the new RBI governor, Feroze Azeez, and this is Sanjay Malhotra's first MPC, and that is going to happen this week as well. So a potential rate cut could lead to some action on the NII space for banks? And can we see maybe, as a run-up to this anticipated 0.25% rate cut, some more deposits coming to banks this week?
Yes, I think the rate cut is priced in from a debt market standpoint, but of course the deposits growth coming back will require a few more rate cuts and a longish period of this differential rates being prominent to the end consumer of a deposit. So I would say that the sentiment will improve on the banking sector. Bank Nifty can get some reasonable support with this action, which I think is possible, because I'm also looking forward to the first meet of the new governor. And I think from the ministry, if there is a representative in RBI, the thought process is consistent. I love the way the ministry clarified that the budget was not for the middle class because we were worried about consumption. We were worried about the middle class.
Right.
And we want to support the middle class, and the collateral benefit is consumption.
Right.
And it's not the other way around that I wanted to support consumption. I was left with no choice but to support Indian middle class. So that was a very beautiful clarification. The outcome could be consumption, but that was not the reason why that action was taken.
The stated intention, I think the stated intention versus the real intention, because had we seen better GDP growth numbers, Feroze, had we seen no dip in consumption, especially in urban areas, I'm not really sure if Finance Minister would have gone ahead and given this concession to middle class. But yeah, for now, let's take it on face value. I want to come to another interesting sector, and this is the 1 crore gig workers who are likely to be impacted positively by way of their registration on the eShram portal. Now, is this a positive even for stocks like Zomato, Swiggy? And do you think the timing for a company like Zepto to come back and change its domicile back to India and go ahead and participate in the IPO market for the quick commerce space, do you think Budget 2025 has given a little bit, delivered, if I can use that word, delivered a hot boost?
Kartik, on your previous comment, I think you're better judge of what's stated and what actually, honestly, because we see it from a little distance. As a journalist, you've seen it far more closely in terms of stated and actual intents. So I go with you on that topic. Coming to the second point which you made, for quick commerce, what's the budget got in store? In my opinion, the quick commerce business has factored in the next 20 budgets to my mind. So any news which comes, which gives you a short-term fillip, I would not be very, very positive. Because you're speaking about, now look at the kind of results. One result of a 50% fall in one of the large quick commerce businesses results in such volatility in spite of it being overowned. Well, let me give you some data. I'm not giving you any opinion on Zomato as a stock. The highest, I think, 32 crore shares were added by mutual fund industry, different schemes in FY24 in Zomato. In spite of such ownership, this kind of volatility is because people are speculating not to next year. They're not speculating what is going to be the earnings of 2027 FY. They're looking at FY37 also when they're looking at businesses like these, which are reasonably volatile on their bottom line. So I would not be rushing into any business model on one budget, some little positive news, because there are such overwhelming different variables which impact these businesses. I have not seen too many businesses which are overowned by the DII can still throw up such large volatilities on a quarter result basis.
Absolutely, and what you're referring to, we've had that data also on the screen now. In fact, if you look at this calendar year alone, Swiggy is down almost 20% on a year-to-date basis, and you were talking about Zomato. Zomato is also down about 15% or so. So yeah, obviously, I think it'll require a lot more than inclusion of gig economy and budget speeches to understand the business model better and form trading strategies or investment strategies accordingly. Feroze, I also want to draw your attention to some of the Make in India sectoral stocks, and this again is something that the government is trying to incentivize or de-incentivize, as you see it, by way of changes in the basic custom duty. So if you look at TV panels, for example, which will impact a company like Dixon, you have a basic custom duty now increased from 10% to 20%, which means you will have lesser imports and hopefully more manufacturing of TV panels here in India. But the flip side is that for components that go into electric batteries for the EV e-mobility space, you have an exemption on basic custom duty. So talk to us about the Make in India takeaways that you had from Budget 2025.
Kartik, after having tracked so many budgets over the last 7, 8 budgets of Nirmala ma'am, I've realized that those are all page fillers. To my mind, when you look at the expenses which are spent out of our 47 lakh 31,000 crores approximately of our total expenditure, these are all tiny fractions. These are good narratives, and to make sure that the budget speech is at least lasting an hour and a quarter. But to my mind, what I look for is the top 10 expenditures and some key expenditures. So Make in India, but the budget is now being treated as a budget, not like a speech, because budget is about kharcha kitna, amdani kitna. And मैं खर्च कहाँ करने वाला हूँ, that is also provisional. That gets changed in May, maybe again. So point I'm trying to make is budget should be seen not as an event, as a disclosure by the government of how much will they collect, where will they spend. So Make in India, I think there are better platforms where they give you more information than a budget does, or the bill which subsequently gets released. But what I would want to draw your attention to is Home Affairs, which has got a 68% growth or in allocation from 1,30,000 to 2 lakh kariban, somewhere thereabouts, almost a lakh crore increase or 95,000 crore increase in Home Affairs and 1% increase in education. The last 5 budgets has increased our education budget by 7%. Now, what happens is, because we are distracted with so many budgets, we forget the compounding impact. Other than our portfolios, there is compounding impact on our expenditure. We were spending 85,000 crores in FY19 in education. Now we are expected to spend only 1,21,000 crores, which is saddening for a country whose average age is 29 years.
Absolutely. Well, let's leave it at that for this morning. Feroze Azeez, as always, it's a pleasure having you here on News9. Thank you so much.